Hello class. In this example, we're going to be walking through Treasury stock transactions, and we're going to also see how that affects the dividends that are paid out and then the final stockholders' equity section. To begin with, I've clicked on the optional in-class problems from Chapter 15. You have an algorithm of this on your homework. Looking at the data table, we see that we have common stock, we have the number that is authorized, and then we have so much that is issued and outstanding. At this point, since issued and outstanding are the same, we know that there is no Treasury stock as of yet. And then we have our additional paid-in capital for common. There's a zero balance here from this new APIC account we're going to talk about, and we have retained earnings. Okay, to start this problem, we're going to work through the journal entries. And so the very first one is we are acquiring our own common stock to be held in Treasury. So these are common stock shares that we have issued, but we want to buy them back, and we have reasons for doing so, which may include that we're going to offer them later as something for management, or just we may issue them out later. So let's just take a look at how this works. And I'm going to kind of shorten the video by clicking my problem answers in there. So to walk through this, you bought 15,000 shares of stock, and so you paid $16 a piece. The cash that came out of your account in order to buy them is simply that $16 times 15,000 shares, and we debit the account Treasury stock, and that is a contra stockholder equity account. So in our next transaction, we sold 4,800 shares of stock, but we sold them at 19. We show that the cash coming in is $19 times those 4,800 shares. We're going to take out of the Treasury stock account the same amount, 4,800 shares, but we're going to multiply them by the original cost of $16 a piece. That gets us our 76,800. The leftover is its new account called Additional Paid-in Capital from Treasury Stock Transactions, and that is a plug figure. Later, we sold 7,200 more shares, but now we sold them for $8 a share. Now remember, we bought them for 16, we're selling them for 8. Okay, there's various reasons this could happen, but this could be a management stock option, and an exercise price was named at $8. We learn about those things in a later chapter. So just trust me for now. The cash that's coming in is simply the 7,200 times the $8 per share. The Treasury stock that's going out, that's being reduced, is the $16 per share times the 7,200. Now, in order to make the debits equal credits, what we have to do is figure out how do we account for these other items. If we have additional paid-in capital from Treasury stock transactions already, we go ahead and debit that account, and in this case we had 14,400, we wipe that out. Anything left over, it comes out of retained earnings. If we had nothing in the additional paid-in capital account from Treasury stock transactions, the entire amount to make debits equal credits would have come out at retained earnings. In the next step, we have a net loss for that year. And so we have to close out the income summary account. So we just assume that the income summary is going to have a credit balance after doing the other closing entries. And so we debit retained earnings. That reduces retained earnings, which normally has a credit balance. The next tricky part comes to declaring the dividends. We only pay dividends on the ones that are outstanding. So what we have to do is figure out how many shares of stock do we pay the dividends on. So what I'm going to do is just switch over to a different page here, and you have access to this on your it's listed under the chapter resources. So it keeps track of all of our beginning shares. We acquired some, we sold some back. So at the end of this period, we end up with 95,950 in outstanding shares. We multiply that by $2 a piece for the dividend, and that gives us our 191,900. So we go ahead and we show that here. we have a dividends payable account, and then they pay it several weeks later. So far, so good. The last part is the trickiest part, and that is putting together the shareholders' equity section at the end of all these transactions. So what you can see here is that the common stock still is at $10 par value. We have the amount of, they didn't list our authorized amount, but we have that many issued. But notice the number outstanding now is 95,950. So we still have some in Treasury. And the difference is down here under less cost of Treasury stock. We still have 3,000 shares of that Treasury stock that we haven't reissued. So 3,000 times $16, the original cost, shows here as our contra stockholders equity account. Our additional paid-in capital account, that has not changed, and there is no other APIC from Treasury stock because we wiped out that balance. We have our new retained earnings balance, and I'll show you the computation for that. Again, this is on something that's available to you. And we have a beginning balance. We show the loss. We show that one transaction when we reduced retained earnings because we sold that Treasury stock much below the original 16. We show the dividends, of course, coming out, and so our ending balance of retained earnings shows up there. So when we get down to doing our stockholders equity section, we have to have our new retained earnings account there. So I know I spoke rather quickly through this one. You can slow it down or watch it over, but hopefully this helps at least for one of those long problems on your assignment.